And you hear KKR, propensity here to lean into triple Cs, but then you have the spread problem. And so the question is, do you buy at spreads you're seeing right now, Ken?
Spreads are clearly tight. And it's hard to go out and say buy the entire market at the moment. I think you need to be very selective. Chris is an old friend. I've known him for a long, long time. And I agree with him that there is credit risk in the marketplace. I don't, however, happen to see the likelihood of a major increase in defaults in the next 9 to 12 months.
Now, it's interesting, Oksana, you made this point earlier about how you're not really getting much bang for your buck over treasuries. So why go into credit risk at this point in time?
That's my question. Why go into credit risk at this point in time? Double Bs, many double Bs, which is the highest kind of quality of junk, if you will, have a 6 handle on the yield, and you can earn almost as much in the 3-month T-bill. So why would you go into junk? But I think even perhaps more importantly, we typically, investors, associate growth with strength in credit. And our base case is that the economy will continue to do fine, will continue to do okay. These rates obviously are not tremendously restrictive. However, if we do continue to see growth, that means a higher for longer environment, which will make it more difficult to refinance. You know, that 12.6% rate that Hertz is refinancing at, that wasn't the case 4 or 5 years ago or even 3 years ago, right? That's going to continue to bite. Furthermore, if the strength actually somehow accelerates and you have higher rates, that is going to take a bite out of credit. And we've seen on dates when rates move up significantly, or even looking back at 2022 when rates caused all those losses, they caused them across the board. Because when spreads are razor thin, you just don't have the cushion there.